All right, so are you ready to totally decode the language of the markets? Because today we are diving in headfirst into technical analysis.
We're talking charts, patterns, and all the good stuff.
You guys sent us this awesome YouTube video by the Trading Channel, and it is jam-packed with insights.
It's a bit of a monster, though.
It is a little dense, I'm
Yeah.
not going to lie, but that's why we're here to break it all down.
Step by step.
Yeah, so you can walk away feeling like you've got this secret weapon for your trading.
It's like learning a new language, right? It can seem intimidating, but once you understand those basic building blocks, you start to see these patterns and opportunities you never even noticed before.
That's what I love about technical analysis. It's like you're a detective uncovering these hidden clues in the market's movements.
And the cool thing is, once you know what to look for, it's like a whole new world opens up.
And speaking of clues, this video jumps right into candlestick charts, which are like the footprints that tell the story of price action.
Each candlestick, it's like this little battle between buyers and sellers over a specific period.
And that time frame, they emphasize that in the video. That's super important to keep in mind.
Oh, yeah, for sure.
So imagine like a 5-minute candlestick chart. Each candle is representing 5 minutes of trading activity.
Like a tiny little snapshot of the market's mood swings.
Yes, exactly. Like those courtroom sketches where they exaggerate the expressions to show, who's winning the argument.
Love that analogy.
So a green candle, that means buyers are in control, right? They're pushing the price higher.
Right. And a red candle, the opposite sellers are in charge driving the price down.
And those little lines, those wicks sticking out from the candle, what are those all about?
Those are showing you the highest and lowest points the price hit during that time frame.
Okay, so it's like the range of the battle.
Exactly. And the size of the candle body that tells you how strong the buyers or sellers were.
So a big green candle, that's like a decisive victory for the buyers.
You got it. And a small candle means the battle was more of a stalemate.
Got it. So we've got our candlesticks down, but how does the time frame, like we were talking about before, how does that affect those battles? Because you could have a 5-minute chart.
Yeah, you could have a 5-minute, a 15-minute, an hour, daily, weekly.
Right. So how does that all...
Changes everything.
Okay.
Because let's say you see this tiny little green candlestick on a 5-minute chart.
Okay.
Might not seem like much, right? But if you switch to a daily chart, that same green candle could represent a massive price surge.
It's all about perspective.
100%.
The time frame you choose, it's like using a zoom lens.
Exactly. And that's where identifying trends comes in.
Okay. Trends.
Because you can't just blindly follow trends.
No, they made that very clear in the video.
Yeah, that's a recipe for disaster.
Yeah.
But knowing how to objectively spot those trends, that's where the edge is.
They kept emphasizing impulsive moves and pullbacks. What did they mean by that?
So imagine the market taking 2 steps forward during an impulsive move,
Okay.
then 1 step back during a pullback.
Got it.
That's how healthy trends often develop.
So it's not about the market going straight up or down. It's more like taking the stairs.
Exactly. And here's a key takeaway in an uptrend. Those pullbacks should never break below the lowest point of the previous pullback.
So each step up is creating a higher low.
You got it. And for a downtrend, you're looking for those lower highs.
Each step down, creating a lower high.
Precisely. It's all about that steady rhythm, those higher lows and higher highs.
And speaking of levels, this is where they dive into one of the most fundamental concepts in technical analysis.
Support and resistance.
Yes, support and resistance. It's like those invisible force fields where the price seems to bounce around.
Love that analogy. Think of support like a floor and resistance like a ceiling.
Okay.
These levels, they represent price points where the market has struggled to break through in the past.
So it's like the market has a memory. What was once a barrier becomes a potential launching pad for the next move.
Exactly, and that's what makes support and resistance so powerful.
But I'm going to say one thing I've always struggled with is actually drawing those support and resistance lines. It feels a bit subjective,
Yeah. Totally. And that's why they stress the importance of using support and resistance with other tools and analysis.
Okay, so what other tools are we talking about here?
Okay.
Because I'm ready to get into the nitty-gritty.
Get ready for some indicator insights because this video is about to unleash their top 3.
Now we're talking. Hit me with the first one. What's the secret weapon in their trading arsenal?
First up, ATR average true range.
ATR. That one always sounded a bit intimidating to me.
It's actually pretty straightforward once you get the hang of it. Think of it like a volatility gauge on your trading dashboard.
Okay.
It tells you how much the market is likely to move on average over a certain period.
So like a speedometer for price swings.
Exactly.
Okay, so a high ATR means we're in for a bumpy ride. And a low ATR means things are relatively calm.
Right.
But how do we actually use that information to our advantage?
So the video really hammered this point home. ATR is crucial for setting realistic stop-loss orders.
Okay.
So instead of just placing your stop-loss randomly, you base it on the market's actual volatility.
So if ATR is telling us the market typically moves like 100 pips a day, setting a 10-pip stop loss is like trying to catch a runaway train with a butterfly net?
Exactly. You're going to get stopped out just from normal market noise, not because your trade idea was actually invalid.
Right.
And here's another crucial insight they shared. ATR isn't just about different time frames.
Yeah.
It's also about different currency pairs.
Right, because some pairs are naturally more volatile than others.
For sure. So ATR helps you adjust your risk management based on the specific market you're trading.
Okay, so it's like having a personalized volatility bodyguard for your trades.
I like that.
All right, on to the next indicator in their arsenal. What's next?
Next up, a classic, the moving average.
Moving averages.
Okay.
Simple tool, but incredibly versatile.
Okay, so moving averages, those lines that kind of smooth out the price chart, right?
Exactly.
What makes them so special?
Well, they talked about using them to define trends,
Okay.
identify potential areas of value where the price might reverse,
Okay.
and even as trailing stop-loss levels to lock in profits as the market moves in your favor.
Wow, talk about a triple threat.
Right.
But how do you know which moving average to use? It seems like there are a million different options.
Yeah, there are a ton, but they mentioned that the 20, 50, and 200 period moving averages,
Okay.
particularly popular.
So it's like finding the market's VIP section and seeing where all the cool kids are hanging out? Exactly. And, because so many traders are watching those levels, it can actually create these self-fulfilling prophecies where the price reacts predictably around those areas.
No, that's fascinating. It's like the market responding to its own reflection.
Right. Pretty cool stuff.
It is. But they also emphasized you never want to rely on moving averages alone, right?
Oh, absolutely not.
Okay,
Always combine them with other tools and analysis for a more holistic picture.
got it. It's all about putting the pieces of the puzzle together.
Exactly.
Now, before we move on, I'm curious about another indicator that I've heard a lot of traders buzzing about, RSI.
RSI.
Yeah.
What's your take on that one?
Ah, yes, RSI, the Relative Strength Index. They actually do a great job of debunking a common misconception about this indicator.
Okay, I'm listening.
A lot of traders use it to try to spot overbought or oversold conditions. Right.
But the video emphasizes that RSI is actually a momentum indicator.
So just because RSI is screaming overbought doesn't mean we should hit the sell button right away.
Exactly. Think of it more as a measure of a trend's stamina.
I like that. So if RSI is high, it means the trend has a lot of momentum, but it might be due for a breather soon.
Precisely. Now, they did share one of their favorite ways to use RSI, and that's in conjunction with something called divergence.
Divergence. That sounds intriguing. What is that all about?
So picture this. You're watching the price make higher highs like it's climbing a mountain.
Okay.
But then you look at RSI and it's making lower highs.
So it's like the market is putting on a brave face, but RSI is secretly whispering, this rally is running out of steam.
Exactly. That mismatch between price action and RSI can sometimes signal a potential reversal is brewing.
Wow, it's like RSI is giving us that behind-the-scenes look at the market's true emotions.
Right. Like a secret window.
I'm starting to see why they emphasize that RSI. Like all indicators, it's just one piece of the puzzle.
100%. It's all about context.
All right, so context is key. Are you ready to dive into the world of candlestick patterns?
Oh, yeah. Let's do it. They shared some real gems in this video.
Okay, because candlestick patterns, those are like the secret codes of the market.
Right. They're giving you little hints about what might happen next.
But here's my challenge with candlestick patterns. It feels like there are a million different interpretations out there.
It can be overwhelming, I know.
How you know which ones to trust?
That's where having those clear objective rules is crucial, and this video delivers.
Okay.
They share their top 3 candlestick patterns.
Okay, I'm ready.
And they break them down step by step.
Okay, I'm ready to unlock these secrets.
Ah.
What's the first pattern they break down? Breakout patterns. Those sound exciting. What are they all about?
Breakout patterns. Those are all about volatility.
Okay.
It's that shift from like a period of low volatility consolidation to higher volatility and a potential surge in momentum.
Ooh, so it's like the market's been doing stretches,
Yeah.
and now it's ready to sprint.
Exactly.
Which breakout patterns are we talking about here?
So they focus on 2 popular ones,
Okay.
flag patterns and then ascending and descending wedges.
Okay, let's start with those flag patterns. What makes them so special?
So imagine a market that's been trending strongly in one direction.
Okay.
Then it kind of takes a little breather, consolidates in a tighter price range, and that consolidation phase often forms this like rectangular shape that looks like a flag on a pole.
Okay, I can picture that.
So that pole is that initial impulsive move,
Right.
and then the flag is that consolidation phase.
Got it. And I'm guessing the trade comes when the price breaks out of that flag formation.
You got it. Breakout above the upper trend line of the flag usually signals a potential continuation of the uptrend.
Okay.
Breakout below the lower trend line suggests a continuation of the downtrend.
So it's like the market is catching its breath, gathering its energy for the next big move.
Exactly.
Did they mention any specific rules for trading these flag patterns, though?
They did. They actually have a key rule.
Okay.
Only trade flag patterns that form within a highly volatile trend.
Okay, so we want to see some action first.
Exactly. And they actually use the 20-period moving average as their filter for volatility.
So if the price is dancing above that 20-period moving average forms a flag pattern, we're good to go. But if it's below, probably best to stay away.
Exactly. They want to see that underlying strength in the trend before jumping into a breakout trade.
Makes sense. Don't want to get caught in a false breakout like that friend who always says they're going to run a marathon but never actually trains.
The one that's all talk.
Yeah, exactly. Now, what about those ascending and descending wedges? Those sound kind of intriguing.
So wedges, these are very interesting patterns.
Okay.
Picture this. An ascending wedge
Okay.
typically forms during an uptrend.
Okay.
You see the price making higher lows, but the highs are getting less and less enthusiastic.
Okay, so it's like the buyers are kind of running out of steam.
Exactly. So it forms that wedge shape pointing upwards.
Right.
Hence the name.
But you said it forms during an uptrend. So is that a bullish or a bearish signal?
That's the thing about technical analysis. Sometimes those patterns that seem counterintuitive can be the most powerful.
Okay. I like where this is going.
So with an ascending wedge, even though it's forming in an uptrend, it's actually a bearish signal.
Oh, interesting.
The trade setup is a breakout below the lower trend line of the wedge,
Okay.
suggesting a potential reversal to the downside.
So we're looking for that breakout below the wedge to confirm the pattern.
Exactly.
Okay. What about a descending wedge? Is that the opposite?
It's the opposite. Forms during a downtrend.
Okay.
Lower highs and lower lows, but the breakout comes to the upside, signaling that the sellers might be losing their grip and a move higher could be in the cards.
So with both wedges, we're looking for that breakout in the opposite direction of the wedge itself.
Precisely.
Clever. And they emphasize that with both wedges, they prefer to wait for a pullback toward that breakout point before entering a trade.
Always manage that risk.
Right. Right.
Enter at a favorable level.
Got it. Well, we've covered a ton of ground here, from candlestick patterns to chart patterns, breakout patterns. It's like we've unlocked the secret language of the markets.
It's a lot to take in.
It is. But I have a feeling they saved the most important lesson for last, didn't they? Reed, what is it?
This video ends with this very powerful reminder.
Okay.
Technical analysis. It's just one piece of the trading puzzle.
Oh, right.
To really succeed, you need to master the other two pieces.
And those are...
Trading psychology and risk management.
Oh, man. I was so caught up in those patterns and indicators. I almost forgot about the mental game of trading.
It's huge.
It's like having a state-of-the-art sports car, but forgetting to actually learn how to drive it.
Right. You can have all the tools in the world.
Right.
But if you don't have the right mindset.
You're going to crash and burn.
Exactly.
So true. So they emphasize that even with a solid understanding of technical analysis, things like fear, greed, our own biases can totally sabotage our trading decisions.
Oh, yeah. Fear and greed, those are powerful emotions.
They really are. It's so easy to get caught up in the excitement of a potential trade and forget about the risks.
Right. FOMO is real.
It is. So how do we master this whole trading psychology thing?
So it's about understanding your own behavioral patterns, recognizing your own strengths and weaknesses,
Right.
and developing the discipline to stick to your plan, even when the market is testing you.
Which is always,
Always.
man, easier said than done.
Yeah.
It's like trying to stay calm during a roller coaster ride.
Right. But that's where the real growth happens.
I guess so. So trading psychology, that's a whole other can of worms. What about risk management? That's something we have a little bit more control over, right?
Absolutely. And the video stresses that risk management, it's not just about setting stop-loss orders.
Okay.
Although that is a crucial part of it.
Right.
It's about determining how much of your capital you're willing to risk on any given trade.
Okay.
Diversifying your portfolio.
Right. So you're not putting all your eggs in one basket.
Exactly. And protecting yourself from those inevitable losing streaks that every trader experiences.
Because let's face it, no matter how good we get at this,
Yeah.
we're not going to win every trade.
No one wins them all.
Right.
And they made this really important point. You can be right about the market direction,
Okay.
but still lose money if you don't manage your risk properly.
Ouch. That's a tough lesson to learn.
It is, but it's an important one
Yeah.
for anyone who wants to succeed long term.
Right.
So
Yeah.
while this deep dive focused on technical analysis, remember, it's just one tool in your trading toolkit.
Right. It's like we've got our candlestick decoder rings, our chart pattern magnifying glass, our indicator toolbox.
Love it.
But we also need to build those trading psychology muscles and fortify our risk management bunker.
Now you're getting it. By combining those three elements,
Right.
technical analysis trading, psychology risk management, you give yourself the best possible chance of success.
I love it. What an incredible deep dive. We covered so much ground and learned so many valuable lessons. I feel like we could talk about this stuff for hours.
Me too. There's always more to learn.
Always. Well, on that note, we'll leave you to explore these ideas, further put them into practice. Until next time, happy trading, everyone.
See you next time.